What if the money we think is a tool for freedom is actually a cage? What if every financial crisis, every bailout, every national debt explosion isn't a mistake, but part of a deliberate system designed to trap nations in endless cycles of dependency? Imagine a world where money has no limits, where governments, banks, and global institutions can create currency at will. At first glance, it seems like infinite opportunity. But here's the twist. Unlimited money doesn't liberate nations, enslaves them. From ancient finance to modern central banking, from trillion-dollar bailouts to invisible strings of global debt, the evidence points to a hidden architecture that ensures some nations rise while others remain trapped. By the end of this journey, you'll understand how the system works, why collapse and debt are inevitable, and what it means for the world's future and your own financial reality. Act I, setting the stage, the illusion of control to understand today. We must first understand the history of money itself. Money before central banking, for centuries, money had inherent limits. Gold, silver, and other tangible assets were the backbone of trade. Credit existed but was tightly constrained by tangible resources. Governments could spend only what they had. Debt had limits. This created a natural balance. Nations could not endlessly accumulate debt without consequence. Crises happened, yes, but they were self-correcting. Failed ventures, bad debts, and reckless policies were punished swiftly, resetting the system. The turning point. Central banks. Everything changed in the early 20th century. The establishment of central banks, most notably the Federal Reserve in 1913, transformed money from a constrained commodity into a tool of infinite creation. Suddenly, governments could inject cash at will, manage interest rates, and control credit flows. At first, this seemed like progress. Nations could finance wars, infrastructure, and social programs without immediate revenue. But the hidden consequence was profound. Money without limits becomes a tool of control. Act 2. Origins of a system designed to trap debt as a mechanism of control. Modern money is mostly debt-based. Banks create currency when they lend, and money disappears when loans are repaid. This is not abstract, it's mathematical reality. For a nation to grow, it must borrow. To repay existing debt, it must borrow more. This creates a dependency loop. Debt fuels growth, but growth must outpace debt, or the system collapses. The role of global institutions, from the IMF to the World Bank. International institutions offer loans that appear generous: development aid, crisis relief, structural adjustment programs. But these loans come with strings attached: currency devaluation, mandatory economic reforms, privatization of national resources. The result is predictable. Nations accumulate debt, lose sovereignty, and remain dependent on institutions that control the money supply. Act 3. The rise of fiat and the illusion of power, the abandonment of gold in 1971. Nixon ended the U.S. dollar's convertibility to gold. This freed money from tangible constraints, enabling unlimited fiat currency creation. For some, this was liberation. Nations could finance programs, stimulate economies, and inject liquidity during crises. But there's a catch. Unlimited money inflates asset prices, erodes purchasing power, and allows the wealthy and powerful to extract value disproportionately. The system now favors those who control money creation, while ordinary citizens and dependent nations bear the cost. Act 4. The breaking point. Global debt traps debt accumulation. Fast forward to the modern era. Global debt exceeds $300 trillion. Many countries spend more on debt service than on education, healthcare, or infrastructure. Defaults trigger intervention. It's often accompanied by austerity or policy reforms dictated by creditors. The breaking point isn't always obvious. Creeps in silently. Inflation, currency, devaluation, budget deficits, rising interest rates. Case studies: Greece 2008 to 2015. Debt spiraled out of control after the global financial crisis. Bailouts came with strict austerity measures that stifled growth, leaving the nation in a trap. Argentina. Repeated cycles of borrowing and default illustrate how debt without limits ensures dependence on international lenders. Third world nations. Loans for infrastructure, energy, and development often lead to foreign control of key assets, locking nations into perpetual dependency. Act V. The fallout of unlimited money. When money has no limits, consequences are postponed, not eliminated. Economic inequality: wealth concentrates in the hands of financial elites. Ordinary citizens face inflation, rising living costs, and wage stagnation. National resources are often privatized to repay debt. Sovereignty erosion: countries trapped in debt lose decision-making power. Their policies are dictated by lenders or global institutions rather than domestic needs. Social consequences: debt traps lead to political instability, social unrest, long-term underdevelopment. In other words, unlimited money benefits the creators of money, not the citizens of nations. Act by failed fixes and false solutions: every major crisis has prompted promises of reform, debt restructuring, financial regulations, bailouts with oversight, but these fixes fail because they do not address the core architecture. Money without limits plus systemic dependence. As soon as a crisis is resolved, new debt accumulates, new bubbles inflate, and the cycle repeats. The system is self-perpetuating, not self-correcting. Act 7. Modern parallels and shocking data. Even today, the patterns persist. Central banks hold unprecedented power over interest rates and money supply. Global debt reaches historic highs, with emerging economies most vulnerable. Financial crises occur in predictable cycles, often benefiting elites while burdening ordinary citizens. Shocking data points: U.S. debt, over $35 trillion. Rising faster than GDP growth. Corporate debt, record highs. With leverage masking underlying weakness, inflation-adjusted asset prices far outpace wage growth. Increasing inequality: these repeating patterns show that the system is not broken, it's functioning exactly as designed. Act 8. 3 key takeaways. 1. Unlimited money creates dependency. Not freedom. Nations can print or borrow endlessly, but the cost is sovereignty, stability, and long-term prosperity. 2. Debt cycles are engineered to benefit lenders. Crises justify intervention and debt accumulation, enriching those who control money creation. 3. Awareness is the first step to resilience. Understanding the system allows nations and individuals to prepare, adapt, and mitigate risk in a world designed to trap them financially. Final warning: open-ended thought. The truth is uncomfortable. Unlimited money is not a tool for liberation, it is a mechanism of control. Every system built on postponed consequences eventually reaches a limit. Nations that do not understand the architecture of debt and money risk permanent entrapment. The question isn't whether the next crisis will occur, it's whether the world will recognize it before it becomes irreversible. Because once dependency is absolute, freedom becomes a distant memory, and the system that promised prosperity ensures only control. Call to action: if this video changed the way you see money, debt, and global power, share it with someone who still believes unlimited money equals freedom. Subscribe for more deep dives into the hidden systems that shape our world. Understanding is the first step toward breaking the cycle and reclaiming control over the forces that govern our lives.